Hey everybody, I'm Mike DeSepoli. Welcome to the Heritage Market Update for February 3rd, 2022. Hope you're all having a great week. Market's having a little bit of a rough day today. Want to explain some of the action we're seeing in the markets, talk about the last week and a half, and some of the encouraging signs we're seeing, as we go through this earnings season, some of the reactionary things we've seen from certain stocks and how it has affected the market. We do think this is one of the biggest earnings seasons in a decade, right? There's a lot of concerns about or from investors about the future path for growth in this economy. Are companies decelerating? Are we having supply chain issues? So we think that earnings season is a good test for that, for a lot of these companies to hear directly from them, to talk about what they're seeing in operation of their business, and are things getting better or worse, and what does the path look like. To this point, we've heard from some of the largest tech companies in the world: Apple, Microsoft, and Tesla, Google as well, with phenomenal earnings reports, beating consensus, above estimates, and more importantly, citing very strong guidance, right? The guidance is their forward-looking assessment for the next quarter to 2 quarters, and are companies raising guidance, meaning they think there's an acceleration of growth, or are they lowering guidance, which means they would obviously see some problems that need to be contended with. Looking at the markets here today, markets are down. The big news of the day is Facebook, or now known as Meta. It's not a stock that we own, but Meta down 25% today, weighing on the market averages, right? So we're seeing Dow, S&P, NASDAQ, New York Stock Exchange, everything's down across the board. And the reason for that is Meta, right? Now, here's Facebook. What we're seeing here today is one of the largest single drops from a large cap, mega cap tech company in American history. I believe Facebook has shed about $250 billion of valuation today. So naturally, when a stock that was close to the $1 trillion market cap capitalization gets hit this hard, it's going to tend to have an effect on the market. We still think we have a lot more good earnings than bad that have come out. And we think the case of Facebook, and the reason I'm talking about something that we don't own, we think this is an outlier. Okay, Facebook has been greatly hurt by Apple's new privacy rules, which are preventing them from selling your data and doing targeted advertising. And as a result, they saw a slowdown in some of their ad dollars. So we think that Facebook is the exception, not the rule. We think that the report that they put out yesterday, while it wasn't awful, certainly cited a slowdown in some of those ad spend categories. But when we look across tech, like I said, Apple, Google, Tesla, and we'll see later this week a couple other big market components reporting, we think the trends are there. We think that the forward-looking guidance was strong. Apple specifically talked about easing of supply chain constraints, right? So that was a hangover on growth for a lot of these companies. So we're seeing a lot of good things there as well. But yet, looking at a 26% drop today from Meta, a very large drop for a very large company. So while we do see that here and now this is weighing on the markets, we don't think the effect long term will be withstanding. Let's take a look at the market, right? Here's the NASDAQ, right? Over the last couple years, we've obviously been going through a pretty sharp correction here. Let's zoom in a little bit. And we're doing a little backing and filling here today, but we still believe that we have a meaningful tradable low in place as of January 24th. Now, anytime you see the market move this much in a very short period of time, this is the market moved up, the NASDAQ that has moved up about 1,500 points in just over a week, right? So in a very nice move off the low, which gives us confidence that the lows are in place. But then all of a sudden we get a day like today where markets roll over a little bit and everybody starts to get nervous, right? So even here, this is just the last 5 days alone, right? Very powerful rally coming out of Friday morning, which we opened lower and finished higher, and follow through into Monday and Tuesday. And even yesterday, market's pretty flat, but today we're getting a little weight from Facebook. So we'll hear from Amazon after the close. That'll be another important one to watch, just to see what the trends in their business look like and how that we can extrapolate that data to make an assessment across many of the other companies that we own. We do see a very interesting setup here in the market where investors have gotten so bearish, so negative, so pessimistic about this market, and it's rivaling previous times in history where we saw pessimism get this high when there was major cataclysmic events going on, right? And just looking at the chart we have here on the screen, this is 2009 through 2022. The red line is the S&P 500, and the blue is levels of investor bearishness, right? So the higher the blue lines go, the more bearish investors are. The lower they go, the more optimistic they're feeling, or on the contrary, feeling bullish. Now, generally, if you look across, anytime we see this level of bearishness, which is where we're at right now, it tends to coincide with pullbacks in the market, right? Markets go down, people get scared, everybody starts to bet against the market, thinking the best days are behind us. And this tends to act as a contrarian indicator because just as everybody gets negative, just as everybody gets bearish, the market finds its footing and is ready to run higher. So we don't think it's a coincidence that as this level of bearishness has creeped up to multi-year highs, and as a side note, investors are now more bearish today than they were in March of 2020, February, March of 2020, when the pandemic first really struck us, which we find is rather absurd that people feel worse about this market now than then. But again, it talks to the irrationality that we're seeing in the marketplace. And ultimately, we think as a contrarian signal, this will mark a bottom. We think that bottom is in place, and we'll see, of course, over the next couple days and weeks if that will be confirmed. We want to share some other data points with you as well, right? We're hearing a lot of talk about Russia, Ukraine, geopolitical conflicts. What is this going to do to the market? We've compiled some data here from our friends at other research institutions that have put this together. And this is just showing you all different geopolitical events. Even COVID-19 is in there, which I'm not sure if you'd call that a geopolitical event. But we're airstrikes, drone strikes, bombings, terrorist attacks, suicide attacks, all these different things, invasions, Kennedy's assassination, all the data is here. And what we see is, yes, maybe in the short term, the market grapples with some of these realities and gets a little bit nervous. But when we look at, let me just move this to the side so you can see here. When we look at how long did it take the market to bottom and what the recovery looked like, the market recovered from all of these events each and every time. So we don't really put a lot of importance. Of course, anything when there's potential invasion catches our eye. But as far as market importance, we don't think the Russia-Ukraine conflict is going to be something that knocks us off the rails. Another thing we keep hearing about is how bad January was, right? The worst January in the last decade. And a lot of people feel that as goes January, so goes the year. Okay, well, we have the data compiled to show you that that is also not the case. So we put together some bad January returns and looking at what the market did in the final 11 months of the year. And what we have found is when we have a January that's negative, like we just had, 90% of the time, right, really in all instances except for one, the market was higher for the remaining 11 months of the year. That one example notwithstanding, the financial crisis of 2008, obviously that took some time to sort itself out, but we know that markets are resilient and they can recover from these bad starts to the year. Another thing we want to look at is how do stocks fare after corrections, right? We know we're in a correction, gone through a correction. We think most of the worst of it is behind us, but nonetheless, until further notice, we are still in it, and corrections all feel pretty crummy when you're going through them. But for perspective, right, how can we expect the markets to behave coming out of these corrections? So we've compiled data from previous corrections, all going back to 1980 through the current. And we see that when we look at returns in the market, both 1 year after and 2 years after, we're seeing abnormally high results in positive territory, or a very high frequency, I should say, of positive results. 1 year after the lows of the correction, we see the market is higher 90% of the time. And 2 years after the lows, markets are higher almost 87% of the time. So again, right, nothing is guaranteed in markets, but these are the type of probabilities that we would want to bet alongside of, because when you tend to get corrections like this, it makes the market a lot cheaper. It tends to bring in a lot of investors back into the market, maybe some that had been trapped on the sidelines because they had panic sold back in March of 2020. Now they're getting an opportunity to get back in, new capital coming into the market, and a lot of companies have become a lot cheaper. And if they still have good core businesses, this is something that we see that tends to play out. So corrections take some time to work themselves out. Going back to the NASDAQ here for a second, obviously we've been going through this here for quite some time. It's normal to have some choppiness as we try to regain our footing and come out of this. But again, we think the economic environment, the macroeconomic environment supports our thesis, right? And let me just lay this out for you. Markets have been under pressure because the Fed is talking about raising interest rates. The reason the Fed wants to raise interest rates is because we keep hearing how strong the economy has been. Well, that narrative has shifted a lot and very drastically over the last couple months. We've had three very bad jobs reports in a row, and we're expecting a fourth one tomorrow to be very much underwhelming. We got the weekly payroll numbers yesterday, where economists were calling for a gain of 200,000 jobs, and the actual number was a loss of 300,000 jobs, right? So a big miss there. Our first negative payroll read since 2020. And again, we're not rooting for the economy to start to roll over here by any means. We want the U.S. economy to be strong and everlasting, but we are just trying to show you that the economic data is more so recessionary than resurgent, right? So we think this sets the stage for the Fed not to hike rates 8 times or 7 times or 6 times, or some of these absurd numbers that we've heard thrown about by financial news media. We think maybe 1 rate hike or maybe 2. And I think when the market comes around to that reality, they will realize that this is not a tightening process where we're trying to constrict the economy. The economy still needs support from the Fed. The economic recovery, while it's certainly moving along nicely, we are not done. The work is not yet done. So let's keep an eye on that jobs report coming out 8:30 a.m. tomorrow morning. That's Friday, February 4th. We think, again, that will validate a lot of what we're talking about here. And again, folks, that we're not just making these type of extrapolations or guesses based upon a feeling in the pit of our stomach. We have seen this play out in real time, probably 4 or 5 times since the advent of monetary and fiscal policies from the Great Recession in '08 and into 2009. And we've seen these freakouts in the markets about higher interest rates. We saw it in 2011, 2013, 2015, and 2018. And here we are again in 21/22 going through the same thing. All previous instances, the Fed did act, but didn't act nearly as aggressively as the market was expecting. And once they realized that that was the case, markets started to rally. So we don't think this time will be any different, but corrections can be tough. We know that they can be wearing on the mental and the psyche of investors. But we're here to just tell you, keep calm, invest on. We have a plan. We're sticking to that plan, and we are respecting the data as it's coming into us. And right now, that data still points to this market having room to move higher. So one day doesn't break a trend. We still think a bottom is in place from January 24th. So let's give it a couple days and see how the market shakes out here. But if you have any questions, please reach out to us. Always happy to talk to you about the things that matter with your money. Have a great day, and we'll see you back next time.